Welcome to Real Vision Live. I am your host today, Ed Harrison, here for Real Vision. I am talking to Mike Howell of CrossBorder Capital. Mike, welcome to the show.
Thank you. It's great pleasure to be here. Hi, Ed.
But we're going to talk about liquidity, actually. And I was thinking about the story you were telling me about the liquidity of tea, what's going around in the UK these days in terms of when people are talking about liquids, they're talking about a viral video that an American was making English tea. But I thought it was a hilarious story. Maybe we'll have a chance to talk about it later on. But we're actually going to be talking about, financial liquidity more than anything else. And right before we went on, I was telling you, Mike, that a lot of people are talking about liquidity from the perspective of speculation and whether or not that speculation is being driven by liquidity. But the reality is that we have a lot of central bank liquidity going into markets. And I want to get a sense from you, because this is a thesis that you've been following. What is going on right now in markets in terms of liquidity? How much longer can it go on?
Well, the answer is that markets respond to money. There's a huge amount of money around. Liquidity creation is the name of the game. Central banks are moving with alacrity this time. They're pumping money into markets at a rate that we've not seen before. Why were investors wrong-footed in March? I think the very simple reason was that nobody really judged correctly the scale of this injection, of this monetary response. Central banks are slated to increase global liquidity, a number we track, by perhaps 40% this year. I mean, this is an unprecedented injection of liquidity. If you look by comparison, take US liquidity as this one measure, and you look at what happened after the global financial crisis in 2008-9, basically what you saw at that stage was an increase in total liquidity of something like in total 7%. So the stock of liquidity went up, sizably, but not dramatically. You're talking easily 4 to 5 times that amount this time around. I mean, the numbers just bear no comparison. And speed is another factor as well.
Right. So basically, we're awash in liquidity, and that is buoying markets. But, when I was talking to you, you were talking also about, markets from an underinvestment perspective in terms of the rotation between various asset classes. Talk to me, one, about, what sort of an impact that has when you think about liquidity, but also in terms of, psychology versus fundamentals in different markets.
Okay, well, let me sort of start at the beginning. If you look at what liquidity drives, it primarily drives fixed income markets and forex markets. And in terms of the way that we judge investment, to our mind, about 80% of the movement in fixed income and forex markets are down to macro fundamentals, of which liquidity is a major component. Investor psychology, behavioral aspects, probably about 20%. If you look at the stock market, those numbers are reversed. It's about 20% macro factors, probably 80% psychology, and hence the difference. Now, if you look at how liquidity moves through the system, it tends to migrate initially into fixed income and forex markets. And the thing that you would expect to see first of all from a liquidity surge is a steepening in the yield curve. In other words, a steeper term structure. And that's exactly what we're seeing.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
Going on right before our eyes right now. You're seeing that. As that liquidity starts to move through the system, you would begin to see risk appetite beginning to increase. That risk appetite would elevate equities. Money is pouring into stocks, as we see over the last few weeks, and equity markets are being buoyed up. a rising tide floats many boats, and there's a lot of liquidity there to float.
And so what about the concept that the steepening yield curve is negative for equities, and that because, the discount factor is increasing as the yield curve steepens? Is that something that you think is eventually going to be a problem, or is that not a consideration?
Correct. It will eventually be a problem, but it's not a problem now. And if you look at typically movements of the yield curve tends to precede periods of accelerating economic growth. Hence, this is what we should be expecting. And it also presages a rise in equities, but particularly cyclical stocks. Now, your point about rising fixed income yields is very well taken, and that will be a bogey for the market at some stage. I would suspect that the yield on the 10-year Treasury has likely got to test 2% before it becomes a meaningful constraint. So we've got some way to go. But on the other hand, if you look at the liquidity impulse that we've seen so far, we think it's likely to elevate the yield curve perhaps by another 150 basis points. So we're going to be testing those sort of levels. And our prognosis is that, look, make hay while the sun shines, as they say. This year is likely to be a pretty good year for financial assets. Next year, 2021, is going to be a lot more problematic. And I think the reason for that is you've got a lot more problems really out there. One of those could well be inflation. Another one is that central banks are not going to keep up the momentum of this easing at the current rate. There's going to be an inflection, and markets don't like inflection points.
Interesting. Yeah. So let's talk about those one by one. First, we've got the inflation side, and then we've also got the reeling in the liquidity side. Talk to me first about inflation and what gauges of inflation you're looking at to think about inflation.
Well, I think inflation is an issue one needs to address, as I say, maybe on a more medium term or 2021 like horizon. But I think the instructive thing is to look back and to go to the 1970s when inflation was a serious issue. Now, the background in the 1970s was a number of features. One of those was that the US dollar was weakening. Well, okay, it's firm now, but perhaps it's beginning to roll, but let's not make too much of an issue there. But there was massive monetary growth. We were seeing monetary growth of the order of sort of between 15 and 20%, peak growth rates around 1971, 72 in the US. The sort of growth rates we're looking at now, just by comparison, are nearer 40% annualized. So let's put this into context. There's a lot more money around this time. And the second thing that you saw in the early 70s was that supplier delivery times, in other words, how long it takes a supplier to deliver goods, was starting to lengthen quite significantly. Now, Alan Greenspan, remember him, always used to say that the best leading indicator of inflation in the US system is the supplier deliveries question on the ISM, the Purchasing Managers Survey. And if you look at what that is showing in the last 2 months' observations, there's been an upward spike. And that would foreshadow rising inflation about 12 months out. That is entirely consistent with what monetarists say about the risk of this monetary surge feeding through into the real economy and higher inflation. So that's what I would be concerned about, not least because the fixed income markets are nowhere near discounting this risk yet.
Right. So, I mean, let me put this in a nutshell. So you got a steepening yield curve, which is a sign that people expect a more buoyant economy as a result of a lot of liquidity that's going into the markets. And that is buoying equities for now. But then as we move towards 2021, some of the negative, more pernicious sides of that are going to happen just as the Fed is easing back and other central banks are easing back in terms of the 40% annualized rate of liquidity injection that they're putting in now. And that's when potentially inflation will come into play, and there's going to be some volatility associated with that.
Yes, I think correct. Now, I think the point to note for investors is really this, is that if we're in an environment where you've got moderate or creeping inflation, that environment is wholly negative for the fixed income markets, but it's broadly relatively positive for equities. Equities can do quite well out of that because effectively dividends or earnings are indexed to rising inflation. The problem comes when you start to get higher inflation of rates nearer 5 to 10%. Now, if you look at when monetary growth rates are in the US at the moment or in other countries, Europe, UK, they're kind of pointing to a risk that inflation could temporarily surge into that sort of bracket. Now, nothing is certain. We've got to be alert to it, but that's obviously a possibility. In that environment, if inflation gets embedded at those higher levels, then it's a negative for all financial assets. You go back to the 1970s and you look at the paradigm we were in then, it was very clearly a real asset environment where financial assets, stocks and bonds did very badly. Now, we're not there yet, but we've got to look at the risks. What I would say is the risk this year is that inflation begins to pick up a little bit. In that environment, bonds are going to do terribly, and there'll be a switch of assets into equities. Now, the point about the bond markets relative to equities is that is where the real bubble is. People are saying that equities are speculative. Make no mistake, the fixed income markets are by far and away more speculative. You've just got to look at the term premium or the negative term premium, which is bond markets risk premium, essentially, the risk for holding duration. That is an unprecedentedly negative rates. Textbooks say you shouldn't be buying fixed income when you've got anything below a zero term premium. But now we're looking at maybe 150 basis points negative on the 10-year treasury. It's crazy.
So what do you think, what's behind that? Why is it that term premium are negative when normally they've been positive in the past?
I think part of the story is liquidity, and part of the story is a shortage of safe assets. Mm-hmm. What you've got to look at is the background that we've been traveling through over the last decade. Now, the point that we make persistently or continually, ad nauseum, so to speak, is that what really matters here is balance sheet, it's liquidity. And the reason it matters is that we're sitting out there with a stock of debt that totals something like $300 trillion worldwide. Now, the point about debt is not the fact that it's pernicious per se, but you've got to refinance it. That's really the problem, okay? You've got $300 trillion of debt. What it means is you've got to refinance, on average, $60 trillion every year. So you've got to have balance sheet space to do that, to roll that debt over. Now, if you're in an environment where there is an absence of liquidity, what liquidity's absence means is that balance sheet capacity is not there. So you have difficulty in rolling over debt, and hence you get financial crises. So the last decade have been littered with a series of financial crises because of lack of liquidity. Every time the Federal Reserve decides to step back, or there's a sudden shock to the system, like the repo scare last year, you get a problem with refinancing. Financial markets today are not new capital raising mechanisms, they're refinancing mechanisms. And that's really the critical point. In a refinancing mechanism, balance sheet matters, interest rates do not, okay? And that is the thing that central banks have kind of got wrong. They're miswired for this world. They've got to look at balance sheet. The Federal Reserve, I think, has now got that message. It woke up very fast late last year, but they now understand that balance sheet is critical. Going to negative interest rates is a crazy, crazy policy. And if you look back in the last decade, the policies that governments have pursued, which is fiscal austerity, which increases the debt load on the private sector, or low interest rates, which encourages the private sector to take on even more debt, is just a crazy way of trying to solve these problems. What you need is effectively policies that will create growth and not lead to increasing debt. And that's the bottom line.
Right. And we're not necessarily going to get that. Now,
we aren't.
One of the things that we could get, obviously, as you were saying, is inflation. How do you go against that? A lot of people have been talking about break-evens. Talk to me about what break-evens are saying and whether that's a good way to think about inflation.
Well, break-evens are saying there's no inflation, but break-evens are a biased indicator for the simple reason they incorporate the same negative term premium that I've been railing against for the last few minutes. It's a biased indicator. What you've got to start to look at is leading indicators of inflation, of which things like the ISM survey, commodity prices, potentially what happens to the dollar, the price of gold, supply delivery, lead times, all these factors are going to be much more critical. Now, what I can do is, if I can pass to some charts, I can walk you through some of the framework that we look at, and hopefully what that can show is some of these elements in play, if that makes sense. So let me...
Oh yeah, that makes a lot of sense.
Now, if you look at this chart, what that's showing is our measures of global liquidity basically running back to the 1960s. This particular analysis began when I was at Salomon Brothers in the mid to late 1980s, and we basically coined the phrase then of global liquidity. And this is the path that global liquidity as an index has taken over that time, with various labels put on there, which basically show, the annotations show crises, whether they're asset market booms, banking crisis, or whatever. You can see the V-shaped rebound that we're looking at in liquidity over recent months. And typically what that says is that more liquidity pushes you into a risk-on type environment. The timeline that we show along the bottom is basically saying, how does liquidity migrate through the system? It begins with the fixed income and Forex markets, and then it moves ultimately through to equities and into real economies, maybe a year to 2 years later. So that's the general liquidity picture. What does it mean on this slide here for financial asset prices? Now, the left-hand chart is that same data in terms of global liquidity, but shown as a growth rate in US dollar terms. That is the orange line on the left-hand graph. The black line is the rate of increase in financial asset prices. So that's all world equities, all world bonds, precious metals, all liquid assets, basically into a market-weighted aggregate. And that's the black line as a return number. And what you can see is historically, that matches the growth in global liquidity. There is a lead time where global liquidity typically precedes by a few months, but the correlation is tight. Now, it looks a lot tighter on a big scale like that than it does month to month. If people are interested, the correlation coefficient on a monthly number is about 0.7. In other words, it gives an R-squared of about 0.5. So that's still pretty impressive. But what it's showing is that if you run through using our projections to end 2020, which is using all the slated increases that central banks around the world have promised to put into their markets, the impact of that on global liquidity should be pushing global liquidity up year on year by about 30%, 35% this year. That should mean there's a lot of asset gains to come. Now, drill into the equity markets. And as I said, equity markets are not necessarily so fundamentally driven. A lot of it's psychology. The ratio that we look at and have looked at for many years is this thing that we call the price to money ratio, which is the ratio of total equity holdings worldwide divided by the pool of global liquidity. You can do it for different economies as well. What that right-hand chart is looking at is that ratio over time since 1980. If you do a statistical analysis of that, what it shows, there is very solid mean reversion at around about the 0.55 area, so 55%. That's what the ratio between total equity assets and the pool of liquidity should be. If you project that to the end of 2020 using the same data, current market values, you get to a figure of about 0.37. The low point in the last 6 weeks was under 0.3. We've had a rebound in markets, as we know, since then. But generally speaking, what this is saying is that equity markets still look, although they've got capacity to rise. And that's the key thing. Now,
right. Here, let me ask you a question before you go to this next chart here, because I thought that it was interesting, the chart on the left that you had before that was showing the 30% liquidity, 40% increase, that you're looking at total assets there, world financial asset prices, not necessarily equities only, because I know that you mentioned gold and a bunch of other assets as well.
It's gold, corporate debt, everything, yeah.
Right. So it's not necessarily telling you, here's the asset allocation mix that you definitely need to have. It's telling you that liquidity is going to lead to asset prices going up, and then
Correct.
you're isolating out the equity side on the right side. Is that
correct?
Is that right?
Correct. Absolutely correct. And actually, rising liquidity, as we'll see, is not good for government bond markets. That's the bogey that we've got to face. Now, how does this work? Here is the schematic, which basically shows what's important. What I've said, this is our flow of funds analysis. What I've said is that on the left-hand side, you've got sources of funds coming in. The two most important central banks are the Federal Reserve and the People's Bank of China. More on the People's Bank a bit later, but basically that's what comes in. Then you've got other central banks, the ECB, BOJ, Bank of England, not that important strictly. And then you've got offshore pools of funds, euro dollars, FX swaps, examples of carry trades, which are liquidity creating. That is a total source of funds for global liquidity. And then that dissipates on the right-hand side in uses of funds through various avenues. It goes through into the bond markets via domestic liquidity flows. It tends to hit the Forex markets when we look at the quality mix of liquidity between the private and public sectors. For a Forex investor, private sector liquidity creation is very good, whereas central bank creation is actually a bad thing for the currency. Cross-border flows, the money that wings between markets, tends to hit emerging markets in particular. And then we look at how holdings of liquidity, what we call risk appetite, is really important for equities. And equity markets, we think, respond to a very large extent by the positioning of liquidity within portfolios. So if there's lots of cash around, equity markets tend to do well, which is basically part of the story. Now, let me just go on to some examples which will show you, why this is a useful tool. These were many of the indicators that we devised at Salomon Brothers, and this is in particular one of the things that was used in particular to help trade the government bond markets. And this all goes back to work that was originally done by Henry Kaufman in the 1980s. What you're looking at here is US liquidity as an index, which is the blue line. And what we've done is simply moved current readings on by 6 months. So effectively, we're plotting this in the future. And the orange line is the 10-1-year yield spread on the Treasury yield curve, or Treasury term structure, which is basically effectively lagging liquidity by 6 months. Now, what you can see is that inflections in liquidity drive inflections in the yield curve. All that comes back to term premia. Term premia move with liquidity because treasuries are a safe asset. The 10-year bond is the canonical safe asset for world investors. If there is risk of a systemic risk around, a lack of liquidity, people will drive into US treasuries. Prices will rise, yields will drop, and the term premium will be compressed. And what that means is that the yield curve will flatten. If you get the opposite, when there's bucketfuls of liquidity around, investors think, hey, why should we be holding all these safe assets? We want some risk to make some money. And they start to shift down the risk curve into corporate bonds, into equities, commodities, gold, whatever. And the yield curve steepens. And what
Let me ask you a question there. Two questions. One is the quantitative easing period, where it seems there's a breakdown in terms of the two charts. The other periods, the charts seem to follow fairly closely, but during the QE period, it seems that there's less of a correlation. That's the first question. The second question, this is something we were talking about yesterday in our call, is yield curve control, the 150 basis point steepening. Let me have you get to that first question first, and then I'll follow on with that second question.
Okay, well, let me say, how do we get to 150 basis points of steepening? Just matching up the two lines. If this is a normal relationship, what you'd expect is the yield curve basically to go back to normal levels or to normal peaks, which would be around about, let's say, to be conservative, about 250 basis points of spread. So you've still got quite a lot to run if this is correct. Now, I'd be happy with 100, but hey, it could be more. What about QE? Well, look at the evidence. I mean, it's difficult to see on this because you've got a number of moving parts. But if you go back to term premia, what you will see if you take term premium data, it evidences very clearly that through periods of QE, term premia rise. Through periods of non-QE, in other words, QT, quantitative tightening, you find that term premia collapse. And what we've been seeing principally since the end of QE3 we've seen the yield curve flatten, largely because you've seen an environment where there's been quantitative tightening and term premium have fallen. Now we're seeing term premium beginning to bottom out, and you're seeing this increase. Other question is, what about yield curve control? Well, hey, we may be getting it. Good luck if the federal authorities think they can control the yield curve. It's going to be a lot harder this time around. And let me give you a couple of reasons why that is.
Okay.
If you run back to the period where yield curve control worked brilliantly in the US, which was the period from 1942 to 51, before the Treasury Fed Accord, what you saw there was an environment where the structure of the market was radically different. You basically had an environment where the banks in the US, the high street banks, owned 60% of the Treasury market, foreigners owned 1%, and the Federal Reserve owned 1%. It was much easier to control those flows. Now you've got a situation where it's radically different. Foreigners own 40% of the Treasury market. The Fed owns getting on for 20%, and the banks own 4%. It's a very different equation. That's point number one. Point number two is that if you look at Japan, where they've enacted yield curve control, arguably successfully, because they've been pinning the 10-year JGB down at virtually zero yields, there are two features that you've got to think about. One of those is that beyond the 10-year bond, in other words, in the 20, 30, 40-year tenors, the yield curve is very steep. It's almost L-shaped, so it almost goes vertical after the 10-year. And secondly, if you look at volatility across the curve, volatility now on the JGB market is higher than when yield curve control started in 2017. So it's a bit like squeezing a balloon. You can squeeze one place, but it comes out somewhere else. Now, if you go back to the US context, where could they enact yield curve control? Not at the long end. There's too much of a gap between the 10-year and the 30-year. It's that area of the curve is illiquid, and they've only just started to issue in size 20-year bonds. So it's going to put you back to the front end, where you're talking about 2 to 3 year bonds, maybe doing yield curve control there. It's certainly possible, but go to the Japanese example, and then you're going to get a very steep curve, anything beyond the 2, 3 year, maybe 5 year tenor. And that's the problem. So
let me ask you a question about the release valve being the currency. That is that, you know, foreigners will sell out and they'll say, you know, we don't want this because these assets are not valuable. How about the dollar giving way as the principal effect that you would have as a result of this yield curve control?
yeah, it's a very good point. It's likely. Let me give you an example of why it's likely to happen. And I'm going to shift on. This, by the way, shows I'm not cheating. So this chart just looks at the same relationship with statistical analyses going back in time. But I'm going to go on to this chart, which is explaining the dollar and how our framework looks at the dollar. What you've got here is what we call the quality theory of money. What it distinguishes between is what the Federal Reserve or what policy liquidity is doing, which is the blue line, compared with what private sector liquidity is doing, which is private sector liquidity creation. Private sector liquidity creation comes from a flow of funds concept, which, as I said, was a lot of the work that Henry Kaufman back in the 80s and 90s kind of pioneered. And if you look at what goes into that, it's things like the cash flow generation of US corporates, of US households, the ability to borrow from banks and borrow from shadow banks. All those flows which come from the Z1 accounts are basically calibrated in that orange line. The blue line is pure and simple Federal Reserve liquidity injections. Now, in our view, what really matters is the spread between these two indexes. Private sector liquidity creation is good for the currency for the simple reason that it's telling you that economic growth is likely to be strong and there's a high return on capital. You want the dollar in that circumstance. Federal Reserve liquidity is bad because you just increase the supply of dollars. So it's the spread that's really important. And if you look at that chart, what it's showing is periods where the orange line is above the blue line, and that should correspond to a stronger dollar. And that's pretty much what we find. Now, to put that in a framework, together with what I've just shown in terms of earlier shown on the bond markets, this is how we think of how the markets work. And this is really the link to the fundamentals affecting fixed income and affecting Forex markets. And what it's saying is if you get a combination of very high private sector liquidity and very high central bank liquidity, bond yields tend to rise because term premia are starting to elevate. If you see the opposite of very low central bank liquidity and low private sector cash flow generation, what you're getting is bond yields falling because of term premia. That is the environment that we've been in for much of the last 4 to 5 years because of federal austerity policies, which have basically crimped cash flow in the private sector. And secondly, Federal Reserve QT policies, in other words, the failure after QE3 to add liquidity. What we're in now is the top right. We were in the bottom left. The other two quadrants are saying if you've got high private sector liquidity and a tight central bank, you get a strong currency. And that was very, very much the situation, if you recall, back in the 80s, when private sector liquidity was buoyant because of a lot of treasury spending, which spilled over to the private sector, and Volcker was very tight. And then you go to the opposite extreme, bottom left, where you get high central bank liquidity and you get low private sector liquidity, exchange rate weak, period immediately after the global financial crisis. Now, let
me interrupt you here for a second, because we do have a lot of questions on this. Because one of the foreshadowing questions is what the Federal Reserve will do going forward. Because we talked about inflation as one of the risks, and the other risk was that the Federal Reserve would be reducing liquidity relative to the amount of liquidity that it's giving out, and the same for other central banks. And we have a question here from Angela, who is saying, during his talk to the New York Economic Club, Stan Druckenmiller pointed out that the Fed's treasury purchases have dropped from 75 billion a day in March and 50 billion in April to 4 billion a day in June. Meanwhile, the upcoming treasury issuance to fund the U.S. government deficit massively exceeds the Fed's purchases. So by September, Mr. Druckenmiller foresees a massive liquidity squeeze coming. So rather than liquidity feeding into equity markets, it will now be pulled out. The question to you from Angela is, do you think that the Fed will just turn the tap on again, or will markets have a problem at that juncture?
I think it's a fantastic question. I think that a lot of these same dimensions that Stan Druckenmiller is talking about, we're trying to answer. It's the inflection points that are really critical in terms of understanding how markets are working. I think the real danger is much more in the bond markets because there's a huge amount of coupon funding to do. And up to now, what's happened is that the Treasury has largely issued bills. They're going to start issuing coupons. And that is the implication of this upcoming funding. And is the Federal Reserve going to be there to take it up? Well, I think the amount that the Federal Reserve will likely commit is of the order of maybe about 100 billion a month in terms of purchases. That may not be enough, but there is clearly a lot of liquidity in the system already. Now, I think that if you start to move into 2021, what I would say is that the real problem that the monetary authorities have got to start thinking about is that the commitment to zero interest rates flies in the face of what may be an emerging inflation problem. And they may have to start rethinking this whole equation. But, I'm not going to argue against, what your question has said, because it's clearly a very good point. If they say if the facts change, one changes one's mind. And you've got to look at how the growth rates of liquidity are changing. As far as we can see at the moment, the pool of liquidity is enormous relative to the valuation of equity markets right now. We're at low points, as my earlier diagram said. But clearly a lot of funding can extract that liquidity. No question about that.
Right. Okay. Excellent. Let me go through one or two other questions that we have. Are you expecting an increase in interest rates? This is from Osgur. I would imagine the answer is yes, but is that what you're expecting?
An increase in interest rates?
U.S. interest rates.
I mean, expecting an increase in U.S. bond yields, yeah. I think U.S. interest rates, policy rates, it's going to be very difficult for the Federal Reserve to signal a change in policy rates when they've done their best to sort of try and change expectations into believing that policy rates are going to remain flat for some time. So I think that, if we get an inflation pickup and the Fed has to change, I think they're going to be lagging this significantly.
So in terms of the amount of liquidity that we've had that's been injected, a question from Eric is whether just the sheer amount changes things. His question is, with the speed and size of liquidity injected, is this time now different? Does the rule book on past recessions get thrown out?
Yes, I think it does, because what you're looking at is this a massive difference relative to what we've been seeing historically. And I think if you go back and you look at periods where you've seen rapid monetary growth or liquidity growth in the US, the peak growth rates from my memory have been of the order of 15 to 20% on a year-on-year basis. We stand to beat that this year. Looking at broad monetary aggregates in the US, they may well end the year having risen by 25 to 30%. That would be substantially above the sort of growth rates that we saw back historically, even going back into 2008, going back even into the interwar period, 1935, etc., or even going back to 1971 before the big inflations. These increases are different. Now, the other point that is very relevant here to answer is, what did the banks do in 2008-9 that was different to what they're doing now? The key difference is that in 2008-9, the banks were the problem. Now they're the solution. That policymakers are trying to get the banks to increase their lending. Recall back in 2008-9, what the Basel Accord and what the various regulations that were put in place tried to do was to change the capital to asset ratios of the banks, to bring the capital asset ratios up to reduce lending. And so what you saw was very significant increases in base money, reserve money, in other words, central bank balance sheet expansion in 2008-9. But it didn't really follow through to the monetary or credit aggregates. Now it is. And the fact is that the banks are lending and monetary growth is picking up. And that's really the danger. Just look at the data in the US in the last 2 months, revolving credit, credit card payoffs. $1 trillion. Yeah, I'd say it again. $1 trillion has been paid off from credit cards in the last 2 months. The system is awash with liquidity.
Right. And, when you talk about that, it makes me think of an interview that I saw recently. I don't know if you've looked at the platform and you saw the Hugh Hendry, Richard Werner piece. And I think the sense that I got was Hendry was asking Vanna about, is this time different? Meaning that, is it possible for the central banks to basically engineer a recovery just purely with a wall of money? And therefore, you've got to follow that wall of money. And I didn't feel like I got an answer from Dr. Vanna. What's your view on that?
Well, I think I know Richard Werner very well, because he was operating in Japan pretty much at the same time that I was there with Salomon Brothers and Bearings. And so I know his work, excellent work. And the point that he makes is that, what you've got is effectively window guidance, or you had window guidance by the Bank of Japan, which basically drove lending, drove credit, and that's what drove monetary growth. The same thing is happening now in China, by the way, same kind of system. Now, if you look at what's happening in Western economies, the US is in the forefront of this for the simple reason that US banks, and there's a much wider range of banks in the US. In Europe, there's a handful of banks, but there's lots of different banks in the US who are able to lend at the local level. They can lend to small businesses. They're being encouraged to lend to small businesses. Whereas in 2008, banks were the problem, they're now the solution. So what you've got to start to look at is the growth rate of some of these retail aggregates, monetary aggregates like M1 or M2. And if you're starting to see that picking up, what you know is that money is filtering through much more into the real economy.
Right.
That's where you get the traction.
I was just looking at the time, and we're at about 11:40, and I want to actually kind of do a plug, if you will, for a book that you wrote just recently, because the reason is
I might stop share.
yeah, we Very early on in your slide presentation, you were talking about the two biggest central banks. You talked
Mhm.
about the Fed, and the second central bank that you mentioned there was the PBOC, the People's Bank of China.
Right.
And as you know, there's a war on, if you will, a war of words at a minimum between the United States and China. And the question is how is that going to play out? And I know that you've written about this. What's going on, and how do you see this playing out?
Okay, well, thank you for the plug. I've just written a book called Capital Wars, which is available on Amazon. It really looks at these questions. It was written late last year. I didn't foresee that the COVID crisis would accelerate the trends. The whole idea of Capital Wars is that this is a conflict between the US and China. Effectively, China has been let into the global system. It's exploited its position. It's cheated, in a word, in many ways. And the US is now starting to realize that there is now a serious competition to face. And Capital Wars is really about that. Now, there are various dimensions in this whole question that one can address, but paramount is the control of the currency. And if you look back, in fact, in the book, there's a quote that we put up by Qiao Liang, who is a major general in the People's Liberation Army and often a spokesman for geopolitical events in China. He says unquestionably, unambiguously, in 2015, that the policy of the Chinese administration is to displace the American dollar as the primary currency of Asia. You couldn't be more explicit than that. And what they're doing is they're using their position in the world economy to do that. Now, the problem that China has right now is it has an inability to basically internationalize the yuan. It, at the moment, re-exports dollars where it really needs to export yuan, in other words, renminbi, the Chinese currency. Domestically, the Chinese central bank has enormous control over the financial system. Okay, the PBOC effectively began to adopt fine-tuning operations, if that's the right way of putting it, as recently as probably about 3 or 4 years ago in 2015. And that is to draw a parallel, rather like the beginning of the Federal Reserve in 1913. So you've got to look at these markers. The Federal Reserve is addressing these questions. Just look at the alacrity, for example, with which they dished out swap lines to 14 countries in March. That is the economic equivalent of NATO. What the US is trying to do is to contain China economically in the same way as the Soviet Union was contained militarily by NATO. And these are the things we've got to start thinking about. So we're in a world of capital wars, unquestionably. And I think that if you look at a sort of bigger picture, what you're looking at is a situation whereby the world economy got a lot of its impetus over the last few decades from this split ideologically between the Soviet Union and the Chinese in the 1960s and 1970s. The US exploited that through Kissinger and Nixon very efficiently. They pulled China into the world economic system, and China basically grew very, very rapidly under Deng Xiaoping's reforms and entry into WTO in 2001. China is an economy that will keep going. It is not about to fall off the perch, as many people say. Its banking system is very solid. There's a bad debt problem, but hey, it doesn't matter. It's all local debt for the most part. China will keep going. If you go back to the 1970s, 1980s, a lot of very clever US commentators were arguing, and with great respect they were given, that the Soviet Union would overtake the US economy
Right.
in the 1980s. That's a laughable suggestion looking back. You know, the fact was that the Soviet economy was growing at near double-digit rates through the 50s and 60s, and then it basically faltered. The point I'm making is that China can keep going for another 2 decades, and that's the challenge. The problem that China gives us is that it's going to emerge from this COVID crisis with a disciplined monetary policy. They have not been easing in the same way that the Fed and the ECB have over recent weeks, and with an economy that is going to be growing at probably the fastest rate among the majors, easily the fastest rate by year end. So China comes out of this crisis stronger, and that by itself is a big risk for us all.
Yeah, 2 questions on that. One, I want to go back to 1914 and the British pound versus the US dollar as a comparison. and then the second is about Belt and Road.
Mhm.
So I'm just flagging both now so I don't forget the second question. But when you talk about the yuan replacing the dollar, I think about the dollar replacing the pound. And right now, it doesn't seem like the yuan's ready to replace the dollar because it's, as you were saying, it's not internationalized. Whereas when you look back 100 years, it seemed that the U.S. dollar was ready. How do
Yeah.
you square those two situations?
Excellent question, Ed. I mean, the key point is that in 1914, the US dollar was quoted in fewer markets than the Austro-Hungarian krona. But by 1925, when the British pound went back to gold, it didn't really go back to gold. It went back to being quoted, or went to be quoted against the US dollar. It was quoted at $4.86. Okay. The dollar had come from nowhere to basically being the dominant currency worldwide. It was then held in terms of paper currency reserves. The dollar made up 70% of the world's paper currency reserves from nowhere. How did that happen? It was because in World War I, the British government said to British banks, you are not allowed to lend to anybody outside of the then British Empire, right? Mm. So American banks muscled in. The Federal Reserve had just been created, so that gave them some leverage. And basically, trade was invoiced in US dollars, and there was a trade credit market created in dollars. That's effectively why the dollar got to its preeminent position, and US capital markets were open and could raise money. Now, look forward to what's happening now. China, thanks to its entry into WTO, is the world's biggest mercantilist economy. It's got the biggest exports, the biggest imports. But most of those are invoiced in US dollars. So if they try invoicing or begin invoicing more and more in yuan, you're going to get a trade credit market developing in the Chinese currency. They'll open up their bond market and start to pull foreign funds in. They will create a digital yuan. All three initiatives are starting. Why is it that the Chinese are going around Central Asia creating swap lines? Okay,
right.
Mirroring what the Fed's doing, because they anticipate doing more trade invoicing in yuan. This is out there. It's very black and white, and this is the challenge that we will face with the Chinese currency.
And so, the Belt and Road, where does that fall into place with all of those?
Well, I think if you come back to the Soviet Union example and China, basically the Soviet economy was extremely good at producing a very narrow range of goods. It could produce tractors and maybe low-quality sausages. I'm being facetious here, but it couldn't really produce high-quality technology goods. I mean, you've only got to look at at Soviet equipment. I went over to Russia after effectively the Soviet Union collapsed, and I was struck by the fact that the quality of their engineering goods was really poor. Whereas in the West and the US, equipment was welded. In Russia, it was riveted. I mean, they didn't really have the same sort of technology. Okay, these were clunky pieces of kit, and it was very difficult for them to actually produce consumer goods. When they tried to divert the communist machine towards the production of consumer goods, the whole thing collapsed. And that was basically what led on to Gorbachev, Perestroika, Glasnost, etc. Now, if you look at what's happening in the Chinese context, if the Chinese start to divert their economic machine away from infrastructure and exports, they, I think, will run into a problem, and they may well realize that. So they've got to keep this thing going. They've got to keep the export machine whirring, and they've got to keep the infrastructure machine whirring, which means Central Asia. If they want Central Asia to start to afford all this goods and all this infrastructure, they will have to circulate the yuan, and they have to internationalize the yuan. So the Belt and Road Initiative and the internationalization of the yuan are really two sides of the same coin, and that's how it's going to work.
Right. Very interesting. I'm looking at the time here. We still have about 10 minutes before we're an hour in, and I have a lot of questions, particularly in the first section. And I think these are really important questions because, this is where investors are thinking right now. There's actually a two-parter from James. His first question is, if the dollar weakens further from here, how far and fast is it likely to do so? Which currencies are likely to perform the strongest against the dollar?
Okay. Well, I think the answer to the question is that the dollar will probably roll over, but it's not going to collapse. If you go back to our earlier framework, what really matters is the differential between private sector and central bank liquidity. Federal Reserve liquidity is likely to stay elevated for some time. That may be an impetus to some weakness, particularly if the private sector begins to roll off a little bit as the economy hiccups over coming months. That's possible. And I would suspect that you're likely to see some dollar weakness. On top, I think that the alacrity with which the federal authorities pursued these swap lines to other central banks tells us that the federal authorities do not really want a very strong dollar. So I think that you may see a roll rather than a collapse. What will it move against? Well, I think gold is one of those vehicles that will basically benefit. I think in the longer term, gold looks an excellent choice for investors. I think that the euro currency is likely to go up. I'll come on to that in a second because I'm pretty cynical generally about the eurozone, but there is, and generally, if you look at the Asian currencies, to my mind, what you've got there is there's a lot of de facto shadowing of the dollar. Look at the yen. The yen seems to be very, very stable against a basket of peer currencies in Asia and the US dollar. That I've never seen the yen in sort of 30, 35 years of looking at financial markets anything like as stable as this. There's a de facto targeting going on. So the only currencies that the dollar can effectively move against are the European ones. And I think you may see some weakness. Now, onto the euro. Why do I think the euro may well benefit? Because I think at the center of Europe now is Germany. Germany is getting more and more impetus. The whole of the European Union is effectively shifting eastwards. And if you look at the movement of capital that I outline in my Capital Wars book, one of the things it shows is that the stock of German FDI, fixed investment, outside of Germany is shifting location, should I say, has shifted a location from the west to the east. There's been about a 15 percentage point shift away from America and Western Europe towards Eastern Europe and Asia in stock of German capital in less than 20 years. That is very significant. And if I think back to this geopolitical concept that, what you've had is a splitting up of the Soviet Union and China, which has really underpinned globalization. Notice that Russia and China are getting back together again. That's a danger for the West. And effectively, Russia has to be lured out away from China. And the only way to lure Russia is to pull it more towards Europe. And Germany has to play that role. So I think that Germany is playing a bigger role in Europe. There's more stimulus going on in Germany. The German economy is the only economy in Europe that's reduced its debt in the last 10 years. Monetary growth is generally strong in the German economy. And I think what you've got is effectively the euro is turning more and more into the old Deutschmark. And that's why I think it may be going up.
Interesting words, because as you were saying that, I was thinking about Nord Stream and, the natural gas pipeline, and also what I would call fractures in the Franco-German alliance within the EU. The question is what do the French think about that, to the degree to which, you have Germany in Eastern Europe also on side with Russia through their natural resources?
I think it's potentially a big problem. And I think that what you're going to get is there's not going to be any breakup of the European Union, but it's going to stumble on in the way that it stumbled on in the last 10 years. But it's going to have much more of an Eastern European flavor, and I think that's where the power is lying. And just look at it anecdotally, when Britain joined the then common market in 1974, it negotiated with France. Now with Brexit, it's effectively negotiating to leave with Germany. That's how the power has shifted.
Right. Very interesting. Some more questions that we have here from Colin. He asks, does the scenario outlined by Michael suggest stagflation is the most likely outcome?
Yes, I think it's a distinct possibility. We may be moving in that direction. That was after all what the 70s showed, and we're making many of the same mistakes again. So I think it's entirely possible. Having said that, I mean, we're not in the same sort of high tax bracket that we were in the 70s, and that was one of the things that constrained growth. But on the other side, You've got demographics which are clearly aging, which is really taking some of the impetus out of economic activity. That's much more of a problem for Europe, as we know, than it is for the US or for the UK.
Now, here's an interesting, this is political. I don't know how much you want to wade into this, but it's very important in terms of, policy responses. And before I give you the question, I want to say that, obviously in the United States, it's a very polarized situation. And clearly Mitch McConnell, if he's the majority leader again, it depends on who's in the White House, how he's going to respond in terms of his deficit hawk stance. And so in terms of the question from Michael, here it is. What is Michael's outlook for the S&P for 2021 for the following outcomes? 1, Trump victory in Republican Senate. 2, Biden victory in Republican Senate. And 3, Biden victory and Democratic Senate majority.
Okay, well, I without wading into US politics, I think the third one is the one that the markets will take most badly. The first one is the one that the markets will, I think, take more positively. The middle one is probably a middle ground. But I think, what we've also got to start to say is that there's a bipartisan approach towards China. I think if you look at the statement that the president's office put out about strategic engagement with China, which was a statement put out, I believe, about 4 or 5 days ago. It's really worth reading. I've not seen any administration put out such an explicit letter or open letter to another country before. It's well worth reading for that point of view, because it actually marks out what US policy is going to be. In my view, what really matters for markets in the next 5 years is this capital war framework and the tensions that will basically be between China and the US, and there'll be a lot of play for this. Clearly China has stolen a march through technology in terms of maybe it's theft or maybe it's advancement, but effectively the US needs to catch up, or catch back up, get out in front. So does Europe. So I think there's going to be a huge amount of investment going into technology in the next few years, and that's maybe an area of the markets one has to look more and more closely at.
And how explicit is the split between China and the U.S. going to become in various scenarios? I mean, obviously, you said it's bipartisan, but are certain factions in the West versus other factions in the West more in favor? I'm thinking in particular about the Five Eyes. The Five Eyes agreement, basically New Zealand, Australia, Canada, the UK and the US, they've all been on side with blocking Huawei and saying that, this is it. We're now moving away from China explicitly. Is that something that will continue going forward as aggressively as we've seen over the past 2 to 3 years?
I think yes, and in my view, more aggressively. I mean, this is the key alliance worldwide. It's a critical one. It's proved valuable for the last couple of decades. And I think it's going to persist. And broadly speaking, this is how we need to confront, these challenges. And China has been explicit in what it wants to do, and now, thankfully, the US has put a marker down in the sand to say, these are the lines you should not cross. The US wants a positive engagement with China, but there are clearly elements that it will not tolerate. Interference in Taiwan is clearly one of those. There's obviously a lot of concern about Hong Kong with US nationals, US businesses, European nationals there. And these are questions that the administration, the current or the future, has to address. But I would say to you, look at the next 3 months in the lead up to the presidential election. Biden and Trump are going to be scrambling over each other to try and outbid who can be most aggressive towards China, I would suspect.
Well, we're almost out of time here. So let me give you a last sort of wrap up question. If you had to wrap up both the short and the long term, because there are two different paradigms here. One is about China and the US, and the other is about global liquidity. How would you tell the Real Vision audience to think about this from an asset market perspective?
Okay, I think in terms of the global liquidity question, what we've seen is that global liquidity absolutely matters. There's no question about that. Anyone that had any doubts after 2008 have had it proved again now. that liquidity matters. And the reason that liquidity matters is that balance sheet is all important. With a debt load of 300 trillion, you've got to refinance debt. Markets are about refinancing. Liquidity is critical. It's there now. It may inflect in some months' time or into 2021, particularly if inflation picks up. But after all, it's a cycle. Watch the cycle. Buy when liquidity is rising strongly. On the question of currency, I think you've got a conflict between the dollar and the emergent yuan. The yuan is trying to take over the US mantle. It won't succeed in the short term. It may be more of a challenger later on. What I would do is to look at gold. I think gold is a winner in this environment. It's a safe haven. And even if the dollar begins to falter, I think a lot of money will move into gold.
Very exciting conversation. Very interesting ideas. Actually, I don't think I've ever seen a framework quite as unique and insightful. So I really appreciate you taking the time. And I cut you off halfway through the presentation that you showed. If we can do this again, let's get to the back half of those charts that you had.
For sure.
Very good stuff.
Happy to do that, Ed. Thanks for your time, everybody.
Thank you.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.